One of my favorite monthly paying dividend stocks, Main Street Capital, or ticker symbol MAIN, has found a spot in my dividend growth portfolio for several years now. Main Street Capital is a business development company based in Houston, Texas that has helped over 200 private companies grow or transition by providing flexible private equity and debt capital solutions. Now, even with Main Street Capital basically trading at all-time highs as of filming this video and up around 25% on the 1-year time frame, not even including the massive dividends, Main Street Capital is facing headwinds that I wanted to talk about in today's video. So if you're a dividend investor, especially if you're interested in Main Street Capital or maybe you have some in your portfolio, make sure to stick around, drop a like down below, and let's get right into this one. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the markets. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So I did come across this article. This is from Samuel Smith from Investing Group Leader. It says bad news for Main Street Capital stock, and it breaks down a lot of what's going on, and I think it's important we all talk about it. It says Main Street Capital is a top-notch business development company with strong dividend growth and low operating costs. However, there is a storm of bad news brewing for the stock. We share our concerns and how investors may want to approach the stock moving forward. It then says Main Street Capital is one of the best business development companies in the world, and that's definitely my pool of thought, as it's delivered market-crushing total returns over the long term, along with strong dividend growth. Additionally, it is backed by an investment-grade balance sheet with relatively low leverage and internal management that gives it much lower operating costs than the vast majority of its peers. Moreover, its management owns over 4% of the company's equity, aligning it well with shareholders. On top of that, though, it has a strong underwriting performance with relatively low non-accruals despite investing in a portfolio that is more aggressively positioned than several of its peers, such as things like Blackstone, things like Blue Owl Capital, etc., etc. Perhaps most impressively, it has generated an average annualized return on equity of 13.7% from 2010 to 2023. The impressive set of credentials makes it one of the truly special business development companies, or BDCs, and has enabled it to earn a rich premium to net asset value, which further accelerates its growth by enabling it to issue equity on a very accretive basis and reinvest that equity into investments that help grow its NAV per share and its dividend consistently. But then the writer said, that being said, there has also been some bad news released lately from Main Street Capital, so let's discuss it. The first piece of bad news, I don't really find it all that alarming, but let's go through it. It says the first piece of bad news is that the sector is dealing with significant other growing competitors, such as companies like Blackstone, Brookfield, Blue Owl, Ares, Apollo, etc., etc. Now, what this means is that there's so much money chasing a limited number of deals. Borrowers in the space have increasingly strong bargaining positions and are able to get more attractive terms or interest rates on new loans, thereby reducing the risk reward for middle market investors like Main Street Capital. Additionally, Blue Owl Capital, which is one of the largest investors in direct lending, has dropped substantially over the past few days due to Jamie Dimon expressing some concerns about the sector. For example, he pointed out that he had seen a couple of these deals that were rated by a rating agency, and I have to confess, it shocked me what it got rated. So it reminds me a little bit of mortgages. He went on to state that not all the people doing it are good, and the problem in financial markets are often caused by not good ones. It's the people that make the mistakes. Another reason to be concerned potentially about Main Street Capital, the U.S. economy is facing an environment where consumer spending is likely going to start slowing soon due to excess savings from the stimulus being completely depleted. The unemployment rate has been steadily rising and is nearing 4%, which could be bullish if you're looking at the Federal Reserve cutting rates. And defaults and delinquencies are beginning to rise across the personal and consumer business segments in the economy, with interest rates likely to remain the same, higher for longer, potentially. This could also cause a problem for middle market lenders like Main, because their own borrowings are largely floating rates and therefore remain at high interest rates. And while their floating rate loan investments may struggle to remain current, as many middle market counterparties are beginning to see their liquidity stretch due to persistently high input costs from things like inflation, higher cost of living, etc. So what the takeaway for these possible headwinds that Main Street Capital has? This writer says, while we do not think the dividend is at risk right now, which I personally do not think it is whatsoever, We do see Main Street Capital as not delivering substantial capital appreciation from this point moving forward, even though it should still be able to issue equity on an accretive basis, bearing a massive collapse in stock price. We do not see any more upside in earning powers from short-term interest rate hikes, since we think the Fed is likely done hiking. Moreover, we expect non-accruals to rise as its counterparties continue to face pressure. We also see opportunities for attractive new investments to dry up substantially given the increased competition in the space, which that's honestly a fair thought. And we therefore do not expect enhanced dividends to be a major part of the investment thesis moving forward. Additionally, we see valuation multiple contraction as being more likely the scenario than expansion moving forward, which will pose another headwind to total return. As a result, we will see the dividend, which is decent right now at around 5.75%, potentially being offset by valuation multiple contraction, and we see little additional per share growth for the foreseeable future. Though there may be a little bit in the near term as a result, we do not see Main Street Capital as being likely to deliver more than mid-single digit annualized total returns moving forward, and depending on what happens with the economy and the sector, we see the total returns for Main Street Capital potentially being close to zero or even negative over the next several years. So in that article, I think there is some good takeaways. I do think the business development company space is becoming more and more competitive, and with the lack of deals on the table, things could definitely slow down and potentially dry up. On top of that, Main Street Capital specifically has seen such a run over the last year or so, up 25% of the last year with dividends included. Main Street Capital has a total return over the last 365 days of like 33%. Now, with Main Street Capital trading close to all-time high near $50 per share, I also agree that it's very possible that Main drops down to the mid or low 40s in the next year or so. But I do think due to management, Main Street Capital's lean business, and the historical performance to go off of, I think Main Street Capital has potential to reach new higher highs in the next 10 years personally. Along with it, the fact that Main Street Capital's dividend is relatively safe also helps me sleep well at night, because I personally do own hundreds of shares of Main that I've been buying for several years now. Now, as of right now, I'm still grabbing a share or two of Main here and there, but I'm not in a place right now that I really want to buy a ton of Main Street Capital unless we see a massive dip and maybe see it down a little bit lower in share price, but that's just me personally. But with all that said, I lastly want to hear from you guys down below when it comes to Main Street Capital. Are you currently buying any Main as it sits, or do you think this one is topped out? Let me know in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.